There is a lie, a very expensive lie, at the heart of the modern financial world. It's a lie whispered in the marble lobbies of Wall Street skyscrapers, coded into the flickering algorithms of high-frequency trading firms, and printed in the glossy, jargon-filled prospectuses of 1,000 different hedge funds. The lie is that wealth is a function of complexity. It's the idea that to beat the market, to achieve real, lasting financial freedom, you need a secret formula, a black box, a Ph.D. in quantitative finance, and access to instruments so baroque and convoluted that they defy simple explanation. This lie is not an accident. It is a product. It is the single most profitable product Wall Street has ever created, because it does two things with breathtaking efficiency. It makes you feel inadequate, and it makes them incredibly rich. They sell you complexity because complexity carries a high price tag. It allows them to charge exorbitant fees for strategies that are deliberately opaque. It creates a priesthood of finance, where they are the gatekeepers of the sacred knowledge, and you, the retail investor, the entrepreneur, the person simply trying to build a secure future, are the humble supplicant, meant to hand over your capital and your trust without asking too many questions. But what if the entire edifice is built on sand? What if the secret to crushing the returns of the most sophisticated financial minds on the planet isn't more complexity, but radically less? What if the most powerful tool for portfolio growth wasn't a supercomputer, but a simple sentence, a clear idea, an unwavering commitment to the understandable? This isn't a hypothetical question. It is the central operating principle of the single greatest investor in modern history. Warren Buffett, the Oracle of Omaha, has built a $100 billion fortune not by out-complexifying Wall Street, but by sidestepping their game entirely. His method is a rebellion of simplicity in an age of contrived confusion. He has proven, for over 60 years, that the most sophisticated strategy is to know what you own and why you own it. It is a method that prevents the single most costly market mistake, paying a premium for confusion. By the end of our journey today, you will not just understand this method, you will possess a framework to apply it, to cut through the noise, to reclaim your confidence, and to begin building wealth with a clarity and peace of mind that Wall Street can never sell you. This is the final promise of simplicity, superior returns, with less stress, fewer fees, and the unshakable power that comes from true understanding. We begin with the foundational pillar of Buffett's entire philosophy, the very bedrock upon which his empire of rational thought is built. It's an idea so simple, it seems almost insulting to the high-powered intellects of the financial world, yet its misapplication is responsible for more lost fortunes than any market crash in history. This is the principle of the circle of competence. It is the discipline to operate only within the boundaries of what you genuinely, deeply understand. To say, without shame or fear of missing out, "I don't know," and to treat those three words not as a sign of weakness, but as the ultimate financial superpower. It is the conscious decision to ignore 99% of the investment universe to focus with intense, unwavering clarity on the 1% you can master. Our story, the foundational anecdote that brings this pillar to life, doesn't take place in a moment of brilliant insight, but in a period of immense public ridicule. The late 1990s. The dot-com bubble was in full swing, a manic, euphoric party that was rewriting the rules of business. Companies with no profits, no tangible assets, and often no coherent business plan were seeing their stock prices levitate to astronomical heights. Names like Pets.com, Webvan, and GeoCities were the darlings of the day. The NASDAQ index was a rocket ship, soaring day after day. Financial television was a constant drumbeat of new paradigms and information economies. And in the middle of this nationwide frenzy, Warren Buffett looked like a fossil. He was openly, publicly, and relentlessly criticized. Barron's, the venerable financial weekly, ran a cover story in 1999 titled, "What's Wrong, Warren?" The article painted him as a relic, a man whose old-world principles of value and cash flow were hopelessly obsolete in the new digital age. He was missing the boat. He was past his prime. His refusal to invest in the hot tech and internet stocks was seen as a catastrophic failure of vision. At the annual Berkshire Hathaway meetings, shareholders, many of whom were watching their neighbors get rich on stocks like Qualcomm and Cisco, would pepper him and his partner, Charlie Munger, with questions. Why weren't they buying into this revolution? The pressure was immense. And Buffett's answer was devastatingly simple. He would say, again and again, that he simply didn't understand them. He couldn't, with any degree of certainty, project what the earnings of these companies would look like in 5 or 10 years. He couldn't look at a company like an online pet food retailer and determine its durable competitive advantage. He couldn't tell the difference between the 20 dot-com companies that might change the world and the 400 that were destined to go to zero. And because he couldn't understand them, he wouldn't play. He was defining the edge of his circle of competence, and technology, for all its world-changing promise, was outside of it. He said, "It's not a criticism of the people running it. It's just, I can't get my mind around it to the point that I want to write a check for $1 billion." He chose the pain of looking foolish in the short term over the risk of being a fool in the long term. And then, the bubble burst. Between March of 2000 and October of 2002, the NASDAQ Composite Index fell by 78%. Trillions of dollars in paper wealth evaporated. The darlings of the new economy became punchlines. Pets.com, which had raised $82.5 million in its IPO, went bankrupt just 9 months later. The critics who had mocked Buffett fell silent. By staying within his circle, by choosing the simple, understandable businesses he had known for decades, insurance, consumer goods, utilities, he had not only preserved Berkshire's capital, he had kept it ready. While the rest of the market was in ruins, Buffett had a war chest, ready to deploy into the wreckage and buy wonderful businesses at bargain prices. The very act that made him look like a fool in 1999 cemented his legacy as a genius in 2001. The power of this story lies in the immense psychological pressure Buffett had to withstand. This brings us to the underlying psychological principle at play, the disciplined overriding of two of the most powerful and destructive cognitive biases known to human decision-making, the Dunning-Kruger effect and the fear of missing out, or FOMO. The Dunning-Kruger effect is a cognitive bias whereby people with low ability at a task overestimate their own ability. In investing, this manifests as the amateur who, after a few lucky trades in a bull market, believes they are a financial prodigy. They mistake luck for skill. The dot-com bubble was a Dunning-Kruger petri dish. Everyone felt like a genius because everything was going up. The act of buying a tech stock, any tech stock, was immediately rewarded, reinforcing the false belief that they knew what they were doing. Buffett's approach is the ultimate antidote to Dunning-Kruger. The first step of wisdom, according to him, is knowing the limits of your own knowledge. By constantly defining what he doesn't know, he immunizes himself from the overconfidence that leads to ruin. He operates from a place of intellectual humility, which is the rarest and most valuable commodity on Wall Street. The second bias, FOMO, is even more primal. It's the anxiety that an exciting or interesting event may currently be happening elsewhere, often aroused by posts seen on social media or news. In the late 90s, the event was the dot-com gold rush, and the social media was CNBC and cocktail party chatter. Your neighbor, your brother-in-law, your dentist, everyone seemed to be getting rich, and the psychological pain of being left behind was immense. This is herd bias in its most potent form. Human beings are social creatures, hardwired to find safety in the crowd. When the entire herd is stampeding towards a cliff, it takes an extraordinary act of will to stand still, let alone walk in the opposite direction. Buffett's commitment to his circle of competence is a system for depersonalizing the decision. It's not about his willpower versus the will of the crowd. It's about a simple, binary rule. Is this within my circle? If the answer is no, the conversation is over. It doesn't matter how much money other people are making. It doesn't matter what the pundits are saying, the rule is the rule. This transforms investing from an emotional, gut-wrenching battle against FOMO into a cool, logical, and far less stressful process of classification. He has built a psychological firewall that protects his capital from his own most primal instincts. So how do we, as retail investors or entrepreneurs, translate this into a practical, usable tool? This leads us to the applied mental model, the blueprint for defining your circle. This isn't a vague concept. It's a step-by-step process you can execute today to bring immense clarity to your investment principles. Step 1 is the inventory of expertise. Take out a piece of paper or open a new document. Create 3 columns. In the first column, list your profession. What industry do you work in? What specific knowledge have you acquired over years of professional experience that the average person doesn't have? If you're a software engineer, you have a deep understanding of cloud computing. If you're a doctor, you understand the healthcare and pharmaceutical industries. If you're a logistics manager, you know more about supply chains than 99% of hedge fund managers. This is your primary circle. In the second column, list your hobbies and intense interests. Are you a passionate homebrewer who understands the craft beer market? A gamer who knows the video game industry inside and out? A car enthusiast who can spot trends in the automotive sector a decade away? These are areas where your passion has led to genuine, practical knowledge. In the third column, list the products and services you use and love every single day. What brands have earned your unwavering loyalty? From the soft drink you choose to the insurance company that holds your policy, this exercise creates your personal map of competence. Step 2 is the 5th grader test. For any company that falls within one of those 3 columns, your next task is to subject it to this simple test. Can you explain, in a single paragraph that a reasonably intelligent 5th grader could understand, exactly how this business makes money? No jargon, no acronyms, no vague references to synergies or platforms. Just a simple, clear explanation. For example, for Coca-Cola. Coca-Cola makes a secret syrup, sells it to bottling companies all over the world, who add carbonated water and put it in bottles. The company spends a lot of money on advertising to make people feel happy when they think of the brand, so they will always choose their drink over others. It's simple. It's clear. Now, try to do the same for a complex derivatives trading firm or a biotech company with a single drug in phase 2 trials. The difficulty you experience is a direct measure of how far it is outside your circle. Step 3 is the 10-year projection. For any company that passes the 5th grader test, you must answer one final question. Can you, with a reasonable degree of confidence, predict what this industry and this company's competitive position will look like in 10 years? You don't need to know the exact stock price. You need to know if people will still be drinking Coca-Cola, using American Express cards, or eating Hershey's chocolate. The easier it is to answer this question with a yes, the more durable the business is, and the more firmly it sits within a circle of competence. This blueprint isn't about limiting your opportunities. It's about focusing your energy. It allows you to build a portfolio based on deep knowledge, creating a powerful foundation for long-term investing success. To truly appreciate the power of this model, we must examine its opposite. This is the antithesis, the path of the 99%. This is the story of the investor who lives perpetually outside their circle of competence, chasing complexity and ending in ruin. Imagine a typical retail investor in today's market. Let's call him Mike. Mike is an accountant at a mid-sized firm. He's smart, he's good with numbers in his professional life, but when it comes to investing, his circle of competence is hazy at best. He doesn't follow the blueprint. Instead, he follows the noise. He hears about a new cryptocurrency that's supposedly the next Bitcoin. He doesn't understand blockchain technology, he can't explain what a smart contract is, but his friend made 500% in 3 months. FOMO kicks in. He invests a significant chunk of his savings. Then, he reads an article about a biotech company that has a revolutionary new gene editing technology. The article is filled with scientific terms he doesn't comprehend, but the headline promises to cure cancer. The stock is soaring. He sells some of his blue-chip stocks, companies he actually understands, to buy into the hype. His portfolio is no longer a collection of businesses, it's a collection of lottery tickets, of narratives he doesn't grasp. What is happening here? Mike is paying what Buffett calls the know-nothing tax. He is playing a game where other people have a massive informational and analytical edge. He is the poker player who sits down at a table with professionals and has no idea what game is even being played. The disastrous consequences are inevitable. The cryptocurrency market, notoriously volatile, crashes. He panics and sells at an 80% loss. The biotech company's drug fails its clinical trial, and the stock plummets 95% overnight. In a desperate attempt to make it all back, he discovers complex options trading. He starts buying weekly calls and puts, a zero-sum game that is intellectually stimulating but financially devastating for amateurs. He doesn't understand the Greeks, delta, gamma, theta, but a YouTuber promised him quick riches. He blows up his remaining capital. This isn't a caricature. It is the lived experience of millions of investors who are lured by the siren song of complexity. They believe that because something is complicated, it must be sophisticated and profitable. The reality is that for the average person, complexity is simply a more efficient way to lose money. They have ignored the first and most crucial rule of wealth management. If you don't know who the sucker at the table is, it's you. Finally, how does this principle of the circle of competence manifest in the cold, hard numbers? What is the direct financial connection? First, and most importantly, it dramatically reduces the probability of a permanent loss of capital. A bad investment in a business you understand, like buying a good company at too high a price, will often correct itself over time as the business grows. A bad investment in a business you don't understand, a fraudulent company, a technological fad, a busted biotech, can go to zero, from which there is no recovery. Avoiding the zeros is the single most important factor in long-term compounding. Second, it leads to a much lower portfolio turnover. When you buy businesses you understand and believe in for the long term, you aren't tempted to trade in and out based on news headlines. Lower turnover means dramatically lower transaction costs and, crucially, deferred capital gains taxes. The ability to let your winners run for decades without paying a yearly tax on the gains is one of the most powerful yet overlooked engines of wealth creation available to the long-term investor. Third, operating within your circle gives you the conviction to act decisively when opportunities arise. When the market panicked about the American Express salad oil scandal, Buffett understood the core business and its brand loyalty. This knowledge gave him the courage to invest 40% of his partnership's assets into the stock, a move that would have been reckless for someone who didn't understand the company. This ability to make large, concentrated bets on your best ideas is the key to achieving market-beating portfolio growth, something that is impossible when you have a portfolio of 100 different things you barely comprehend. The balance sheet of a company inside your circle tells a story you can read. You understand what goodwill means for that specific brand. You can interpret the cash flow statement because you know how the business operates. This is the ultimate financial advantage. Clarity in a world that profits from confusion. This leads us to the second great pillar of the simplicity doctrine, the profound and underrated power of a simple business model. If the circle of competence is about knowing the boundaries of your knowledge, this pillar is about deliberately choosing to play in the part of the field where the rules are clear, the game is easy to follow, and the outcome is more predictable. It is the recognition that the best businesses are often the ones you can describe on the back of a napkin. They are the businesses that sell a simple product or service that people want, and they do it over and over again, at a profit. Wall Street, with its obsession with disruption and complex technological moats, often overlooks the sheer, brutal, and enduring power of simplicity. Our foundational anecdote for this pillar is a love story. It's the story of Warren Buffett's affection for a small, family-owned chocolate company from California, See's Candies. In 1972, Buffett and Munger were presented with the opportunity to buy See's for $25 million. At the time, the company was earning about $2 million per year after tax. From a purely quantitative perspective, based on the statistical metrics Buffett had used in his early career, it looked expensive. It was trading at a significant premium to its tangible assets, its book value. The old-school cigar-butt investing approach would have passed on it. But this was a pivotal moment in Buffett's evolution as an investor. He was beginning to understand, largely through the influence of Charlie Munger, the immense value of a qualitative factor, a simple, wonderful business with a durable competitive advantage. What was so special about See's Candies? It was simple. They made high-quality chocolates and sold them in their own stores. That's it. There were no patents, no complex technologies, no arcane financial engineering. But what they had was a brand that was seared into the minds and hearts of their customers. In California, giving a box of See's Candies was a gesture of affection. It was associated with birthdays, holidays, and celebrations. This created an extraordinary psychological phenomenon: pricing power. Buffett realized that customers were not just buying chocolate, they were buying a feeling, a tradition. A person going to buy a gift for their significant other wasn't going to risk switching to a cheaper unknown brand to save $1 or $2. The emotional cost of a bad gift was far higher than the financial cost of the premium chocolate. This simple insight was the key. It meant See's could raise its prices year after year to cover inflation, and then some, without losing customers. This ability to increase prices without a corresponding loss in business is the hallmark of a great business. Buffett and Munger paid the $25 million. Since that purchase, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, and it did so without requiring significant additional capital investment. It became a gusher of cash that Buffett could then use to invest in other businesses. The simple little chocolate company became the blueprint for what Buffett would look for over the next 50 years. Simple business models with powerful, intangible moats. The psychological principle that makes this strategy so effective is known as cognitive ease. Our brains are fundamentally lazy. They are constantly looking for ways to conserve energy. As a result, we have a natural preference for information, ideas, and situations that are easy to process. Cognitive ease makes us feel good, comfortable, and confident. Conversely, things that are difficult to process, a state known as cognitive strain, make us feel suspicious, uncomfortable, and more likely to second-guess ourselves. Wall Street's complex products, collateralized debt obligations, credit default swaps, leveraged ETFs, are the embodiment of cognitive strain. They are designed to be hard to understand. This strain makes rational analysis difficult, so investors often default to trusting the expert selling the product, even when their interests are not aligned. A simple business model like See's Candies is the epitome of cognitive ease. When you can clearly and easily understand how a company makes money, your brain can focus its resources on the important questions. Is this a good business? Does it have a sustainable advantage? Is it run by honest people? Is the price fair? You aren't wasting mental energy trying to decipher an arcane business model. This clarity reduces the likelihood of making a major error of judgment. It also protects you from what psychologists call decision fatigue. When you are forced to make a series of complex decisions, your ability to make good choices deteriorates over time. An investor trying to manage a portfolio of complicated businesses is in a constant state of decision fatigue. An investor who owns a handful of simple, understandable businesses can make fewer, better decisions. The simplicity of the business model translates directly into a clearer, more rational, and less stressful decision-making process for the investor. It's a form of mental arbitrage, exploiting the market's obsession with complexity by focusing on the profitable power of the obvious. So how do we systematize this? We can build an applied mental model called the Moat Identification Blueprint. This is a practical checklist for retail investors and entrepreneurs to use when evaluating a business, focusing on identifying simple, durable, competitive advantages. It consists of 4 key tests. First, the brand power test. Does the company's name or product create an immediate, positive association in your mind? Would a customer pay a premium for this brand over a generic or store brand equivalent? Think of Coca-Cola versus a generic cola, or an iPhone versus a no-name smartphone. This brand power, like with C's, often translates into pricing power, the most valuable asset a company can have. Second, the switching cost test. Would it be difficult, expensive, or just a major hassle for a customer to switch from this company's product or service to a competitor's? Think of your bank. Moving all your automatic payments and direct deposits is a huge pain, so you stay, even if another bank offers a slightly better interest rate. This is a high switching cost. Microsoft Office is another classic example. Entire organizations are trained on it, and the cost of retraining everyone on a new system is prohibitive. High switching costs create a sticky customer base and predictable revenue streams. Third, the network effect test. Does the product or service become more valuable as more people use it? This is the most powerful moat of the modern age. Facebook, for example, is valuable because all your friends are on it. A new social network, even with better features, is useless if no one you know is there. Marketplaces like eBay or Amazon are valuable because they have the most buyers and sellers. The network effect creates a winner-take-all dynamic that is incredibly difficult for competitors to overcome. Fourth, the cost advantage test. Can this company produce its product or provide its service at a consistently lower cost than its competitors? This can come from economies of scale, like Walmart's massive purchasing power, or a unique process or geographical advantage, like Geico's direct-to-consumer insurance model that cut out the expensive agent network. A sustainable cost advantage allows a company to either undercut competitors on price or enjoy higher profit margins. A business that passes one or more of these four simple tests is likely to have a durable competitive advantage, a moat, that will protect its profitability for years to come. This blueprint moves the focus from complex financial forecasts to the simple, underlying qualities of the business itself. To truly grasp the genius of seeking simple business models, we must look at the horror of its antithesis, the path of the 99% who are seduced by deliberate, weaponized complexity. The ultimate cautionary tale here is the spectacular collapse of Enron in 2001. On the surface, Enron looked like the opposite of C's candies. It was sophisticated, innovative, and utterly incomprehensible. If you asked a typical Wall Street analyst in 2000 what Enron did, you would get a jumble of buzzwords. They were an energy trading platform. They created, quote, special purpose entities. They used mark-to-market accounting for complex long-term contracts. The truth is, almost nobody, including the highly paid analysts who recommended the stock, truly understood how Enron made money. Its financial statements were a masterclass in obfuscation. They were designed not to inform but to confuse and conceal. This complexity was a feature, not a bug. It was a giant red flag that most of the market chose to ignore because the stock price kept going up. The company was celebrated by Fortune magazine as America's most innovative company for 6 consecutive years. Investors, caught in the grip of herd bias and FOMO, piled in. They didn't understand the business, but they trusted the management, the auditors, and the stellar reputation. They were investing in a black box. But inside that black box, there wasn't a revolutionary new business model. There was just fraud. The special purpose entities were used to hide massive amounts of debt. The mark-to-market accounting allowed them to book theoretical future profits as current income, creating a fantasy of growth that had no basis in reality. When the truth finally came out, the company collapsed into bankruptcy almost overnight, wiping out $74 billion in shareholder value and the life savings of thousands of its employees. Enron is the ultimate proof of Charlie Munger's famous saying, "If you can't understand it, it's probably crooked." The 99% path is to be impressed by complexity. The Buffett path is to be suspicious of it. The average investor saw Enron's complex annual report and thought, wow, these guys are smart. Buffett would see the same report and think, what are they hiding? This simple shift in perspective is the difference between wealth and ruin. The direct financial connection between investing in simple business models and superior returns is profound and multifaceted. First, it leads to more predictable earnings. Because you understand the key drivers of the business, how many cans of Coke are sold, how many packages are shipped by UPS, you can make a much more reliable forecast of its future cash flows. This predictability is what allows for a rational valuation. When you can't predict the cash flows, as was the case with Enron or the dot-com stocks, any valuation is pure guesswork, which is just a polite word for speculation. Second, the best simple businesses tend to have a very high return on tangible capital. See's Candies, for example, didn't need to build massive new factories every year to grow. Its growth came from its brand, an intangible asset. This means the business generates lots of cash that doesn't need to be reinvested back into the business just to keep it running. This free cash flow is what can be used to pay dividends, buy back stock, or acquire other businesses, all actions that directly increase shareholder value. This is the financial engine that powered Berkshire Hathaway. It is the holy grail of long-term investing. Finally, simplicity acts as a powerful risk management tool. A simple business is less likely to have a hidden, fatal flaw. In a complex business like a major investment bank before 2008, there could be a ticking time bomb of bad derivatives hidden deep on the balance sheet that even the CEO doesn't fully understand. In a business that sells soda or chocolate, the risks, changing consumer tastes, commodity price fluctuations, are generally known and understandable. This doesn't mean there is no risk, but the nature of the risk is far more transparent. This transparency is priceless, and it is the direct result of choosing the simple, understandable path to portfolio growth. We now arrive at the third pillar, a concept that feels almost alien in our hyper-caffeinated, instant gratification world: the aggressive and unapologetic simplicity of patience. If the first two pillars teach us what to buy, this one teaches us the most critical and difficult part of the process: what to do next. And the answer, most of the time, is nothing. The most complex strategies sold by Wall Street often involve a flurry of activity: constant trading, market timing, hedging, rebalancing. They create the illusion of control. Buffett's approach is the polar opposite. It's the discipline to buy a wonderful, simple business at a fair price and then let the inexorable force of compounding do the heavy lifting for years or even decades. This is not passive laziness. It is an active, strategic, and often psychologically grueling commitment to long-term investing. The foundational anecdote for this pillar is one of the most courageous bets of Buffett's early career, a moment that demonstrates how patience, combined with deep understanding, can forge fortunes in the fires of panic. The year was 1963, and Buffett's primary investment vehicle was his small partnership. American Express, one of the most trusted financial brands in the world, was suddenly engulfed in a massive scandal. One of its subsidiaries had made huge loans to a company called Allied Crude Vegetable Oil, run by a man named Tino De Angelis. The loans were secured by the company's inventory of salad oil, which was stored in giant tanks in New Jersey. The problem was, Tino was a fraud. He had filled the tanks mostly with water, with only a thin layer of oil floating on top. When the fraud was discovered, Allied Crude collapsed, and American Express was on the hook for what was then a staggering sum of money, potentially more than its entire net worth. Wall Street panicked. The herd, driven by fear and uncertainty, assumed the worst. They dumped the stock en masse, and the price of American Express was cut in half in a matter of weeks. It was a bloodbath. This is the moment where complex strategies would have involved shorting the stock, buying puts, or engaging in frantic hedging. Buffett did something much simpler. He got on a plane and went to work. He didn't build a complex financial model. He didn't rely on algorithms. He engaged in simple, on-the-ground, qualitative research. He went to restaurants and watched to see if people were still using their American Express cards. He visited banks and saw that they were still selling American Express travelers' checks. He talked to merchants and business owners. His conclusion was simple. The scandal was a fire at a subsidiary, but the core franchise, The powerful brand and the trust it engendered in consumers and merchants was completely untouched. The fundamental business was still intact. Convinced of his thesis, Buffett made one of the boldest moves of his career. He invested 40% of his partnership's entire capital into American Express stock. This was not a trade. It was a massive, concentrated, long-term commitment. And then, he was patient. It took time for the market to realize that the company was not going bankrupt. But as the fear subsided and the company's robust earnings power continued, the stock began to recover, and then soar. Within a few years, Buffett's investment had multiplied many times over, generating a massive profit for his partners and solidifying his reputation as a brilliant contrarian. The lesson was clear. Market panic creates opportunities for the patient investor who has done the simple homework. The psychological principle that Buffett masterfully exploits here is the conscious defeat of hyperbolic discounting. This is our brain's powerful built-in tendency to prefer smaller, immediate rewards over larger, later rewards. It's the reason why so many people struggle to save for retirement, choose the donut over the long-term benefits of a healthy diet, or hit the snooze button instead of getting up for a workout. In investing, hyperbolic discounting is a portfolio killer. It creates an obsession with short-term performance. It's the bias that makes an investor sell a great company after a 20% gain to lock in a small, immediate profit, thereby foregoing the 1,000% gain that would have come from holding it for a decade. It's the bias that makes them panic and sell during a market crash to get the immediate relief of stopping the pain, thereby locking in their losses and missing the inevitable recovery. Buffett's entire philosophy of long-term investing is a system designed to counteract this bias. By framing his purchases as owning a piece of a business, not a flickering stock quote, he shifts his mental time horizon. He famously said, "Our favorite holding period is forever." This isn't just a clever line, it's a cognitive tool. It forces him to evaluate a company not based on what its stock price might do next quarter, but on what its business will be doing in the next decade. This long-term frame makes the day-to-day noise of the market irrelevant. It short-circuits the brain's desire for immediate feedback and replaces it with a patient focus on the underlying value of the asset. Furthermore, the act of not trading provides no immediate reward. There is no dopamine hit from clicking buy or sell. It is the discipline of strategic inaction. This is profoundly difficult for most people, as it goes against the illusion of control. We feel like we should be tricked into doing something. Buffett's genius is the recognition that in investing, most of the time, the most profitable something is nothing at all. He has trained his brain to derive satisfaction not from the immediate reward of a trade, but from the delayed and vastly larger reward of long-term business ownership. How can we turn this into a practical tool for ourselves? The applied mental model is the 10-year test. This is a simple, yet profoundly effective, exercise that you must conduct before buying any individual stock. Before you click the buy button, you must be able to sit down and write out a clear, one-page memo answering a single question. Why would I be perfectly happy to own this business if the stock market were to shut down for the next 10 years? This simple prompt forces a radical shift in perspective. It makes the current stock price, the latest analyst upgrade, and the quarterly earnings whisper number completely irrelevant. You are forced to think like a true business owner, not a speculator. The memo should have 3 parts. Part 1, the business. In simple terms, describe what the business does, who its customers are, and how it makes money. This connects back to the 5th grader test from our first pillar. Part 2, the moat. Clearly identify the company's competitive advantage using the moat identification blueprint. Is it a brand, a network effect, high switching costs, a cost advantage? Explain why you believe this advantage is durable and will protect the business from competitors for the next decade. Part 3, the future. Paint a realistic picture of what the industry and the company will look like in 10 years. What are the major tailwinds that will help it grow? What are the biggest risks that could derail it? This isn't about precise financial projections. It's about a qualitative assessment of the long-term landscape. If you cannot write this memo with clarity and conviction, you have no business owning the stock. This exercise acts as a powerful filter. It kills impulsive, FOMO-driven trades. It forces you to do your homework. And most importantly, when the market inevitably panics and the stock you own drops 30%, you can reread your memo. It will be your anchor in the storm, reminding you of the long-term thesis and giving you the conviction to hold on, or even buy more, while everyone else is losing their heads. The 10-year test is the practical application of patience, transforming it from a vague virtue into a core part of your investment process. To understand the power of patience, we must look at the disastrous path of its opposite. The antithesis is the world of the hyperactive, news-driven trader, the path of the 99%. This is the investor who wakes up and immediately checks the pre-market futures. They have CNBC on in the background all day, their screen filled with flashing red and green numbers. Every news alert, every tweet from a financial personality, every rumor on a message board is a potential signal to act. Their decision-making is not driven by business fundamentals, but by the chaotic, random noise of the market. Let's imagine this investor. A company they own reports earnings that are 1 penny below the quote analyst consensus. The stock drops 5%. They immediately sell, fearing it will go lower. A week later, the company announces a new product, and the stock rallies 15%. They've missed it. They hear a rumor that the Federal Reserve might raise interest rates. They sell all their stocks and go to cash. The Fed doesn't raise rates, and the market soars, leaving them behind. They buy into a hot sector, like solar energy, at the peak of a cycle, only to watch it crash. They then sell at the bottom and chase the next hot thing. This constant activity feels productive. It feels like they are in control. But what is the actual financial result? First, they are ravaged by transaction costs. Every buy and every sell order costs money in the form of commissions or bid-ask spreads. These small costs add up, acting as a constant drag on performance. Second, they are destroyed by taxes. By selling their winners within a year, they are paying short-term capital gains taxes, which are taxed at the same high rates as ordinary income. The patient, long-term investor who holds for more than a year pays the much lower long-term capital gains rate. This difference in tax treatment alone can mean hundreds of thousands or even millions of dollars over an investing lifetime. Third, and most fatally, their market timing is almost guaranteed to be wrong. Study after study has shown that the vast majority of the stock market's gains come in a few, unpredictable days. By trying to dance in and out of the market, the hyperactive trader is almost certain to miss these best days, which absolutely devastates their long-term returns. The path of the 99% is a frantic, stressful, and expensive sprint on a hamster wheel. It generates a lot of motion, but no forward progress. It enriches brokers and the government, while slowly and surely eroding the investor's capital. What is the direct financial connection between patience and extraordinary portfolio growth? It is the eighth wonder of the world, as Einstein supposedly called it, the magic of compounding. The financial impact of patience is not linear, it is exponential. Let's use a simple, concrete example. Imagine two investors, patient Paul and hyperactive Harry. Both start with $10,000. Paul invests in a simple, high-quality business that grows its earnings and stock price at an average of 10% per year. He does nothing else for 30 years. Harry, chasing trends and trading constantly, also manages to achieve a 10% average annual return, make high damps costs. But Harry's hyperactivity costs him. Let's be generous and say his extra trading costs and higher taxes reduce his net return by just 2% per year, down to 8%. The difference seems small. But after 30 years, Paul's portfolio, thanks to the uninterrupted power of compounding at 10%, is worth approximately $174,494. Harry's portfolio, compounding at 8%, is worth only $100, 626. That seemingly small 2% patience premium resulted in Paul having 73% more money. The longer the time horizon, the more dramatic this gap becomes. Patience is the fuel of the compounding engine. Without it, the engine sputters and stalls. On a balance sheet, the value of patience is reflected in the ever-growing retained earnings of the great businesses you own. Year after year, these companies reinvest their profits into growing the business, and you, as the patient owner, are the beneficiary of this internal compounding, a process that is silent, tax-efficient, and breathtakingly powerful over time. This is the ultimate financial advantage of simply sitting still. We now turn to the fourth pillar, an idea that directly challenges one of the most sacred dogmas of modern finance, the virtue of diversification. The conventional wisdom, repeated ad nauseum by financial advisors, is to spread your investments as widely as possible to reduce risk. Own hundreds, if not thousands, of stocks. Buffett's approach is the simple, powerful, and contrarian opposite. Prefer a concentrated portfolio of a few businesses you understand deeply. He famously said, "Diversification is protection against ignorance. It makes very little sense for those who know what they're doing." This pillar is about replacing the illusion of safety from broad diversification with the real, knowledge-based security that comes from concentration. It is the simple idea that your best ideas are vastly superior to your 50th best idea. Our foundational anecdote takes us back to Buffett's early days, long before Berkshire Hathaway became a household name. In the late 1950s and early 1960s, he was running the Buffett Partnerships, a small investment fund for family and friends. Unlike today's hedge funds that own hundreds of positions, Buffett's portfolio was intensely concentrated. He would often have 40 to 50% of his fund's entire capital in a single stock. One of the most telling examples was his investment in the Sanborn Map Company in 1958. Sanborn produced incredibly detailed maps of cities, which were primarily used by property insurance companies to assess fire risk. It was a simple, monopolistic business that had been highly profitable for decades. However, with the rise of new methods for setting insurance premiums, the map business went into a slow decline. But here's the crucial part. Sanborn had a massive investment portfolio, built up from its decades of retained earnings, that was completely overlooked by the market. The stock was trading at $45 per share, but the value of its investment portfolio alone was $65 per share. In effect, you were buying $1 worth of high-quality stocks and bonds for 70 cents, and you were getting the entire map business for free. This was a classic, simple, deep value opportunity. But Buffett didn't just take a small position, he went all in. Over 2 years, he quietly accumulated the stock until his partnerships owned about 35% of the entire company. This concentration gave him influence. He joined the board of directors and, as a major shareholder, successfully pressured the management to unlock the value for all investors. They agreed to use the investment portfolio to buy back shares from any shareholder who wanted to sell at a price much closer to the actual value. Buffett's partnerships made a roughly 50% return on the investment. This was not an outcome he could have achieved by owning 100 different stocks. His success was a direct result of two things: the simple, understandable nature of the investment thesis, and the courage to make a massive, concentrated bet on it. He focused his intellectual and financial capital on one great, simple idea, and the results were extraordinary. This CEO mindset, this willingness to be an activist owner rather than a passive ticket puncher, is only possible with concentration. The psychological principle underpinning the power of concentration is the disciplined avoidance of the paradox of choice. This is the well-documented phenomenon that when we are presented with too many options, we tend to suffer from decision paralysis and, even when we do make a choice, we end up less satisfied with the outcome. Modern finance bombards investors with choices. There are thousands of stocks, bonds, mutual funds, and ETFs. The doctrine of wide diversification tells you to own a little bit of everything. This feels safe. It feels like you're covering all your bases. But psychologically, it's a crutch. It's a way of avoiding the hard intellectual work of identifying truly exceptional businesses. Because you own so many things, you don't really know what you own. Your portfolio becomes a closet index fund, a collection so broad that its performance is guaranteed to be mediocre, just like the market average, but with the added insult of higher fees or the effort of managing it. Concentration is the antidote to this paradox. By limiting your choices, you force yourself to be more selective. It raises the bar for what qualifies as a good investment. Instead of looking for 50 decent ideas, you are looking for 5 truly great ones. This focus simplifies the world. You only need to follow a handful of companies. You can read their annual reports, understand their industries, and track their performance with a level of depth that is impossible with a diversified portfolio. This deep knowledge creates genuine conviction. Conviction is the psychological armor you need to withstand market volatility. When you own 200 stocks and the market drops 20%, your reaction is fear of the unknown. When you own 5 businesses that you know inside and out and the market drops 20%, your reaction is, "This is great. My wonderful businesses are on sale." Concentration, therefore, is not just an asset allocation strategy, it's a psychological strategy for transforming fear into opportunity. To apply this principle, we can use a powerful mental model that Buffett himself has shared, the 20-slot punch card rule. Imagine that when you are born, you are given a punch card with only 20 slots on it. Each time you make an investment, you have to punch one of those slots. And that's it for your entire life. You get 20 punches. Total. This is not a literal rule, of course, but a thought experiment designed to instill a mindset of extreme selectivity, patience, and concentration. How would your investment behavior change if you only had 20 decisions to make in your entire life? First, you would do a massive amount of research before punching a single slot. You wouldn't buy based on a hot tip or a news headline. You would study the business for weeks or months, waiting for the absolute perfect pitch. Second, you would only invest in your absolute highest conviction ideas. Your 20th best idea wouldn't even be on the radar. You'd be looking for the See's Candies and American Expresses of the world, simple, wonderful businesses with durable moats. Third, your holding period would be incredibly long. If each decision is that precious, you wouldn't waste a punch on something you plan to sell in a year. You would be thinking in terms of decades, aiming to let the power of compounding work its magic without interruption. The 20-slot punch card is a blueprint for building a simple, concentrated portfolio. A practical way to start is to aim for a portfolio of between 5 and 15 stocks. This is concentrated enough to allow your best ideas to have a meaningful impact, but provides enough diversification to protect against a single, catastrophic error. For each of these 5 to 15 slots, you apply the full force of the mental models we've discussed. Ensure it's within your circle of competence, that it's a simple business with a strong moat, and that you've completed the 10-year test. This process naturally leads to a simple, powerful, and understandable portfolio. Now let's examine the antithesis, the path of the 99% who blindly follow the gospel of diversification. This is the path of the typical mutual fund or hedge fund. Many of these funds, which charge high fees for their supposed expertise in stock picking, are what's known as closet indexers. They own hundreds, sometimes over 1,000 different stocks. Why? Is it because their managers have identified 1,000 brilliant investment ideas? Of course not. It's for business reasons, not investment reasons. First, it's a defense against looking stupid. If a fund owns every stock in the S&P 500, its performance will never deviate too far from the index. The manager will never have a disastrous year of underperformance, which means they are less likely to get fired or see investors pull their capital. It's career risk management, not wealth management for their clients. Second, it allows them to gather more assets. A huge, diversified fund can absorb billions of dollars in new capital without affecting the price of the stocks it buys. A concentrated fund manager, by contrast, can't manage a huge amount of money because their large purchases would move the market. The diversified fund is a better business model for the asset manager but a worse investment product for the client. The retail investor who follows this path buys into the illusion of safety. They buy a handful of different mutual funds, each of which owns hundreds of stocks. They end up with a portfolio that has massive, overlapping holdings, effectively owning the entire market, while paying multiple layers of fees for the privilege. Their winners are inevitably diluted by their losers. The brilliant performance of their single best investment idea is rendered meaningless because it only represents 0.1% of their total portfolio. They have diversified away their ignorance, but they have also diversified away any chance of achieving truly superior returns. They are doomed to mediocrity, forever earning the market average, minus the significant fees they pay for the service of being over-diversified. This is the costly trap of conventional financial wisdom. The direct financial connection between concentration and superior portfolio growth is stark and mathematical. It's the concept of asymmetric upside. When you make a concentrated bet on a deeply undervalued, high-quality business, your potential upside is many times your potential downside. If you are right, the stock could be a 10-bagger. It could increase by 1,000% or more over a decade. If you are wrong, the most you can lose is your initial investment. A diversified portfolio, by its very nature, cannot capture this asymmetry. A 1,000% gain in a single stock that makes up 0.5% of your portfolio only increases your total portfolio value by 5%. It's barely noticeable, but a 1,000% gain in a stock that represents 10% of your portfolio doubles your entire net worth. That is a life-changing capital gain. Furthermore, concentration dramatically simplifies asset allocation. Your capital is allocated only to your best ideas. This is a much more efficient use of resources than spreading it thinly across hundreds of mediocre prospects. On the financial statements of your personal wealth, a concentrated portfolio will show higher volatility in the short term, but history has shown that for skilled practitioners of this simple method, it also shows a dramatically higher growth rate in net worth over the long term. It is the simple, direct path to moving the needle on your financial freedom. We have arrived at the fifth and final pillar, a principle that may seem softer than the others, but is in fact the glue that holds the entire philosophy together, the unwavering commitment to simplicity in communication and honesty. The way Buffett invests is a direct reflection of how he thinks, and the way he thinks is perfectly mirrored in the way he communicates. He uses simple language, clear analogies, and a folksy, self-deprecating humor to explain incredibly powerful financial concepts. This is not just a matter of style, it is a strategic tool. It is the final piece of the puzzle that separates his understandable value-creating world from the deliberately opaque and value-extracting world of Wall Street. True sophistication is not the ability to make simple things complicated. It is the ability to make complicated things simple. The foundational anecdote for this pillar is not a single transaction, but an annual tradition, the writing of the Berkshire Hathaway annual letter to shareholders. These letters are legendary in the investment community. They are part financial report, part business lesson, and part folksy wisdom. They are also a masterclass in clear communication. Let's perform a simple comparison. Here is a sentence from a typical hedge fund's quarterly letter. We have tactically reduced our net long exposure by monetizing select alpha-generative positions and layering in macro hedges to mitigate tail risk from stochastic volatility. It's a word salad of jargon designed to sound impressive and to obscure meaning. It conveys no useful information. Now here is a classic line from a Warren Buffett letter explaining the concept of a competitive moat. The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage. The products or services that have wide, sustainable moats around them are the ones that deliver rewards to investors. The difference is staggering. One is a fortress of jargon, the other is an open door to understanding. For decades, Buffett has used his letters to educate his shareholders, whom he calls his quote-quote partners. He openly discusses his mistakes, often in great detail, taking full responsibility for them. In his 1999 letter, during the height of the dot-com bubble when he was being criticized, he didn't get defensive. He calmly explained his principles, admitted he didn't understand the new tech companies, and laid out the simple logic of his approach. This radical transparency and simplicity builds an immense reservoir of trust. His shareholders feel like they are part of a shared enterprise, not just numbers on a ledger. This trust is a priceless financial asset. It allows Buffett to take a long-term view, knowing his investors won't panic and flee at the first sign of trouble. The simplicity of his communication is the ultimate expression of the simplicity of his business principles. He is not hiding anything, because in a portfolio of simple, understandable businesses there is nothing that needs to be hidden. The underlying psychological principle at work here is the fluency heuristic. This is a mental shortcut our brains use, where we mistake the ease with which we can process information for a sign of its truthfulness, quality, or value. Things that are easy to read, understand, and pronounce feel more true and more trustworthy to us than things that are complex and difficult to process. When Buffett writes in plain English, he is leveraging the fluency heuristic to his advantage. His clear, simple explanations feel right to our brains. They engender a sense of trust and confidence. We feel like we understand, and that feeling of understanding is deeply comforting. Conversely, Wall Street often weaponizes the opposite of fluency, what we called cognitive strain earlier. Jargon, complexity, and acronyms are used as a form of intimidation. The investment advisor who bombards you with talk of Sharpe ratios, beta coefficients, and quantitative easing is often not trying to educate you. They are trying to establish a power dynamic. They are implicitly saying, "This is very complicated. I am the expert. You are not. Therefore, you should do what I say and pay my fee without question." This tactic is incredibly effective because it plays on our own insecurities about money and our fear of looking stupid. We're hesitant to ask the simple, clarifying question, "What does that actually mean?" for fear of revealing our ignorance. This strategic ambiguity is a tool of control. Buffett's simple communication is a tool of empowerment. He is giving his shareholders the mental tools and the clear understanding they need to be true partners in the business. He treats them like equals, and in doing so, has built the most loyal and long-term shareholder base in the world. So how do we apply this principle of clear communication to our own financial lives? The applied mental model is the annual letter to yourself. This is a powerful yearly ritual that will force clarity, honesty, and accountability into your investment process. At the end of each year, you will sit down and write a 1 to 2 page letter addressed to yourself. This letter must be written in the simplest language possible, as if you were explaining your financial situation to a trusted family member who has no investment knowledge. The letter should have 4 sections. Section 1, Performance Review. In plain numbers, state how your portfolio performed over the year compared to a simple benchmark like the S&P 500 index. No excuses, just the facts. Did you beat the market or did you lag? Section 2, My Best and Worst Decisions. Identify your single best investment decision of the year and your single worst. For each one, explain in simple terms what your reasoning was at the time of the decision and what you learned from the outcome. This is not about celebrating winners and shaming losers. It's about analyzing your own decision-making process. Was your best decision a result of good process or just luck? Was your worst decision a result of a bad process, or was it a good process that just didn't work out this time? Section 3, My Biggest Mistake. This is different from the worst decision. This section is for reflecting on a mistake in your process or behavior. Did you panic and sell during a downturn? Did you chase a hot stock out of FOMO? Did you fail to do your homework on a new investment? Be brutally honest with yourself. Writing it down makes it real and harder to repeat. Section 4, My Plan for Next Year. Based on your reflections, state in simple terms what you will continue to do and what you will change in the coming year. This exercise is the ultimate tool for self-accountability. It forces you to translate the fuzzy feelings and complex rationalizations in your head into simple, clear prose. It cuts through the self-deception that we are all prone to. Over time, these annual letters will become your personal financial diary, a priceless record of your evolution as an investor and a powerful guardrail against repeating the same, simple, costly mistakes. The antithesis to this clarity is the world most investors inhabit. It is the path of the 99% who passively accept complexity and jargon from the financial industry. This is the person who sits down with a financial advisor who presents them with a 50-page proposal filled with colorful charts, complex financial projections out to 3 decimal places, and a portfolio of expensive, actively managed mutual funds with names like, quote, Global Tactical Opportunities Fund. The investor doesn't understand half of what's in the proposal. They don't know what the funds actually own, and they certainly don't understand the fee structure, the expense ratios, the 12b-1 fees, the trading costs. But they are intimidated. The advisor seems smart and confident. The proposal looks professional and sophisticated. So they sign the papers, entrusting their life savings to a strategy they don't comprehend. What are the consequences of this acceptance of opacity? The investor is now flying blind. They receive a quarterly statement that shows a list of funds, but they have no real connection to the underlying businesses they own. They can't answer the simple question, what do you own and why do you own it? When the market takes a dive, they have no foundation of knowledge to fall back on, so their only emotional response is fear. They call their advisor in a panic, and the advisor, whose primary job is to prevent them from pulling their money out, gives them a canned speech about staying the course and long-term horizons, without ever explaining the simple fundamentals of the assets they own. The investor is paying high fees for a product they don't understand, which is almost guaranteed to underperform a simple, low-cost index fund over time. They have outsourced not just the management of their money but their own understanding. They have paid a premium to be kept in the dark, and the financial cost of that darkness over a lifetime is staggering. The direct financial connection between demanding simplicity in communication and your bottom line is immediate and powerful. First, it leads directly to lower fees. When you force an advisor or a fund to explain their strategy and their fees in simple terms, the bad deals and hidden costs are exposed to the light of day. A simple, low-cost S&P 500 index fund has an expense ratio of around 0.03%. Many complex, actively managed funds have expense ratios of 1% or more, plus other hidden costs. That 1% difference, compounded over 30 or 40 years, can consume more than half of your potential returns. Demanding simplicity is the easiest way to perform due diligence and avoid these wealth-destroying products. Second, simplicity is a powerful indicator of business quality. A company with a simple, easy-to-read annual report is often a company with a simple, high-quality business model. Companies with convoluted, jargon-filled reports, like Enron, are often hiding something. As an investor, choosing to only invest in companies that communicate with clarity is a highly effective, if unconventional, risk management strategy. It helps you avoid the black boxes that can blow up your portfolio. Finally, this principle creates a better alignment of interests. When you can have a simple, clear conversation about your financial goals and the strategy to get there, you and your advisor, if you choose to use one, can operate as true partners. This builds the trust necessary for a successful long-term financial plan. Ultimately, simplicity in communication puts you back in the driver's seat of your own financial life, and that control is the foundation of building lasting wealth and achieving true financial freedom. You have just navigated the 5 foundational pillars of Warren Buffett's rebellion of simplicity. You've seen how the disciplined focus of the circle of competence saved him from the dot-com bust. You've understood how the predictable power of a simple business model like See's Candies can become a gusher of unending cash. You've witnessed how the strategic patience during the American Express scandal turned market-wide panic into generational wealth. You've grasped how the concentrated, high-conviction approach of the 20-slot punch card can generate life-changing returns. And you have learned how the radical transparency and simple communication of the Berkshire Letters builds the unshakable trust that is the bedrock of long-term success. You haven't just learned about investing. You have acquired a complete mental toolkit, a new operating system for making rational, confident financial decisions in a world that profits from your confusion. You now possess the framework to cut through the noise, to identify quality, and to hold it with conviction, shielding your portfolio from the twin destroyers of wealth, fear and fees. But here's the crucial next step. Understanding these pillars in isolation is like learning 5 different chess moves. You may know how the knight moves and how the rook moves, but you don't yet know how to play the game. The true genius of Buffett's system is not in the individual pieces, but in how they connect, how they flow into one another to form a seamless, interconnected web of rational thought. The circle of competence tells you where to look. The search for a simple business model tells you what to look for. The 10-year test ensures you have the right time horizon. The 20-slot punch card forces you to wait for the perfect pitch. And the demand for simple communication ensures you are never flying blind. Each principle reinforces the others. They are a network. And you have just mastered the first crucial nodes of that network. The video that is now appearing on your screen is not a random suggestion. It is the next piece of the map. It is the link that connects these principles into a dynamic strategy. It explores the critical element of valuation, the final filter that determines not just what to buy, but when to buy. It's the part of the system that translates all this qualitative understanding into a specific price. The discipline of waiting for what Buffett calls the fat pitch. Mastering the pillars you've learned today gives you the hutace, what. The video on your screen is about the hutace, when. It is the missing link that turns this powerful philosophy into actionable, real-world decisions. The choice to click is not about watching another video. It is a declaration. It is a choice to continue your ascent from a passive spectator in your financial life to an active, confident, and knowledgeable owner. It is the decision to complete the mental arsenal you have begun building today. The map is in front of you. The next step is yours.